Welcome to the Preflight Checklist. Today's checklist is about aircraft sales tax and exemptions. Aircraft purchases are among the largest financial transactions an individual or company will complete. In most cases, some form of sales or use tax applies. What many buyers assume is that these rules are consistent across the country. They are not. Aircraft tax treatment varies significantly by state, and the rules are often more complex and more aggressively enforced than expected. Small misunderstandings can lead to large and unnecessary costs. These are the 5 things buyers should understand about aircraft sales tax and exemptions. Number 1. Sales tax is determined at the state level. Sales and use tax is imposed by individual states, not the federal government. In most cases, tax exposure is tied to either the state where the aircraft is delivered or the state where it will be based and primarily operated. Every state approaches aircraft taxation differently. Some apply a flat aircraft rate, others use a reduced percentage, and some assess the full standard sales tax rate. Even small differences in rates can affect total acquisition cost. Number 2. Several factors determine your tax exposure. Aircraft tax treatment is not driven by a single variable. It depends on a combination of factors, including the type of seller, the delivery location, the ownership structure, and where the aircraft will ultimately be stored and used. Because these factors interact, 2 transactions that look similar on the surface can result in very different tax outcomes. Understanding how these variables work together is essential before closing. Number 3. Exemptions exist, but they require precision. Many states offer exemptions or preferred tax treatment for aircraft purchases. These are not automatic. Each exemption has specific statutory requirements, documentation standards, and timing rules. If an exemption is claimed, proper records must be maintained in case of an audit or inquiry. Failing to meet the requirements can result in the exemption being denied after the fact. Number 4. Flyaway and occasional sale exemptions are common. 2 of the most commonly discussed exemptions are flyaway and occasional sale provisions. Flyaway exemptions typically apply when an aircraft is purchased out of state and removed within a defined period of time. These require careful coordination around delivery location, timing, and documented aircraft movement. Occasional sale exemptions may apply when the seller is not regularly engaged in selling aircraft or other taxable goods. In some states, this allows private party transactions to avoid treatment as retail sales. Both exemptions are highly dependent on state-specific rules and execution details. Number 5. Planning ahead prevents costly surprises. Sales tax is not optional, but it is manageable with proper planning. Coordinating delivery location, ownership structure, and operational plans before closing can have a meaningful impact on total cost. Waiting until after the transaction is complete limits your options and can result in avoidable tax exposure. Early coordination with experienced tax and aviation professionals is one of the most effective ways to keep the process aligned. From our perspective, aircraft sales tax is one of the most overlooked components of an acquisition. Buyers often focus on purchase price and operating cost, while underestimating how tax structure affects total investment. The most effective approach is to address tax considerations early, before documents are signed and delivery is scheduled. With the right planning and documentation, many transactions can be structured efficiently and in full compliance with state requirements. This has been the Preflight Checklist.